Thanks for having me.
All right, so where to begin? I mean, it was bad, but then it was getting better the last couple of weeks. And what does the rally from the last 3 weeks tell you? We're starting to put something together here.
Yeah, so we're still up 10% in terms of Brent and WTI prices from the late June lows, and we think three factors have contributed to the rally. First, and the most important factor is really evidence of strength in physical markets. This return to deficits, that we have been waiting for a while. Inventory drawdowns. Second, the macro data are helping as well, with a reduction in U.S. recession risk and the associated decline in interest rates and the dollar. And finally, I do think that news about tentative reductions in Russia's supply are also contributing to the pickup in prices. We expect the deficits to deepen in the third quarter, averaging a large 1.8 million barrels per day, which should push Brent prices up to $86 per barrel by December of this year. So
let's put it this way. Has anything changed from the beginning of the year when, and I remember, talking to Jeff, obviously, in him saying, look, the supply destocking has been so much bigger than anybody anticipated. And is that headwind finally gone now and markets are back to, to something more resembling balance?
Yeah, so, the significant sell-off in the second half of last year and the first half of this year, we think largely reflected supply-side beat, stronger than expected supply, especially in the sanctioned economies, but also SPR releases, on top of the large negative impacts from higher interest rates on oil demand, because it increased the opportunity cost of holding oil. We think that most of those bearish supply-side factors are now turning. The SPR is getting refilled. We're now seeing tentative signs of decline in Russia production, and the Goldman research view is that the Fed is going to deliver its last rate hike of the cycle next Wednesday. So a lot of these headwinds are fading, and so we think markets will be focused on the large deficits that we expect in the third quarter and in the fourth quarter, reflecting solid demand. Oil demand has been much more resilient than widely perceived, and also ongoing OPEC plus cuts, most notably from Saudi Arabia.
So sum it up for me. The main catalyst that is going to take oil prices into the high 80s on West Texas, and I think it was low 90s on Brent, is what? What is the catalyst?
Evidence of deficits, which means that inventories are going to draw down, which makes oil scarcer, and which should put upward pressure on time spreads. Why do we expect deficits? Because demand is still rising. Actually, we believe that in July this month, the world is seeing an all-time high for global oil demand levels, and that reflects that the global service economy is on a healthy footing. Earlier this month, we had the largest number of global commercial flights ever on record. It's fair that the global goods sector is in a mild recession or stagnation, but even there, we're seeing tentative signs of stabilization. So if we're right that the global service sector continues to expand and services GDP drives about 70% of global oil demand, that in combination with OPEC cuts should lead to inventory drawdowns and to rising oil prices.